Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the industrial clash between Ingersoll Rand, trading under the ticker IR, and Illinois Tool Works under the ticker ITW. ITW operates as a defensive, margin-fanatical vault that trades top-line velocity for elite 26% plus operating margins through its 80/20 simplification engine, whereas Ingersoll Rand acts as an aggressive growth compounder, prioritizing inorganic bolt-on M&A to ingest niche market share and flow creation and life sciences at the cost of short-term margin friction.
Yeah, and I mean, those are completely opposed philosophies.
Completely. So imagine walking into a boardroom, looking at your sales team, and just ordering them to intentionally fire 20% of your paying customers.
Right, just walking away.
Yeah, actively walking away from millions in revenue, just deliberately shrinking your own top line on purpose. To most executives, that sounds like corporate suicide.
Oh, absolutely. They'd think you lost your mind.
Right. But today, we are analyzing a company that does exactly that.
Yeah.
And Wall Street actually rewards them for it. So, welcome, listener, to this deep dive. We are embarking on a true financial investigation here into two distinctly different paths to industrial wealth creation. Both of these giants operate in the massive, sprawling, multi-industry manufacturing space. But their core philosophies on, like, how to build a business, generate free cash flow, and treat a customer, they sit on opposite ends of the spectrum.
And that tension, that's really the central mission of our investigation today. By dissecting their financial reports, their highly revealing earnings calls, and their strategic blueprints from mid-2026, we're going to audit their operational grids.
The literal factory floor.
Exactly, where their sales engineers actually collide. We'll dive deep into the forensics of their margins and map the, drastically different ways they deploy their capital. Ultimately, this equips you to understand which of these two massive industrial machines best aligns with your own investment philosophy.
Because multi-industry manufacturing is a notoriously dense sector. We aren't talking about, consumer apps or retail widgets. We are looking at the structural backbone of the global economy.
Right.
Like if you step onto the floor of an automotive assembly plant or walk into the sterile environment of a biopharmaceutical lab or even inspect the piping of an oil refinery, you are standing among equipment engineered by these two entities.
It's everywhere.
Yeah, but the way they architect their corporate empires is fundamentally divergent. So let's unpack the blueprint of Illinois Tool Works first. Paint a picture of their operational grid.
Okay, so Illinois Tool Works is the purest definition of a sprawling cross-cyclical matrix. They operate this highly decentralized architecture consisting of, get this, 88 independently managed divisions.
88.
88, spread across 49 countries, and they categorize this massive global footprint into 7 distinct segments, which gives them a surface area unmatched by almost any pure-play industrial firm.
7 independent segments implies a staggering level of complexity.
Yeah.
Walk us through how they divide that up, because it dictates entirely what parts of the global economy they're exposed to, right?
Right. So the first segment is automotive OEM. In this space, ITW acts as a specialized supplier to top-tier auto manufacturers. They aren't stamping whole car doors, though.
What are they doing then?
They're providing, highly engineered plastic components, powertrain products, and specialized safety systems that fit into a larger assembly. Second is food equipment. And we have to be clear here.
This isn't your residential kitchen stuff.
Exactly. This is institutional, heavy-duty reliability. We are talking about massive commercial ovens, warewashing systems, and refrigeration units under legacy brands like Hobart and Vulcan. The kind of stuff that sits in the back of vast cafeteria systems.
Yeah, because the physics of a commercial oven operating, 14 hours a day, 7 days a week,
Right.
requires a completely different engineering standard than something sitting in a suburban home.
Completely different.
So what is the third segment?
Third is test and measurement and electronics. This segment produces materials, testing equipment, electronic assembly gear, and highly sensitive weighing solutions used in microelectronics.
Okay, got it.
Fourth is welding. And I strongly encourage you to mentally flag this one because welding serves as ITW's high-margin anchor.
Really? Heavy metal work.
Yeah. In the first quarter of 2026, this segment pulled in an almost unbelievable 32.1% operating margin, producing arc welding equipment and advanced metal consumables under massive brands like Miller Electric.
Wait, a 32.1% operating margin in heavy industrial metalwork is staggering. Software companies writing code barely manage those margins.
I know.
Yet ITW is doing it while physically melting and joining heavy steel. We will aggressively dissect the math behind that when we reach the margin forensics. So what makes up the final three segments?
Fifth is polymers and fluids. This division focuses on value-added chemical fluids, sealants, structural adhesives, and lubricants designed for industrial and aftermarket use. Sixth is construction products, supplying engineered fastening systems and tools to residential and commercial builders.
And that one is cyclical, right?
Very. This segment is particularly notable because it's currently absorbing some heavy macroeconomic headwinds. The Q1 2026 data shows a cyclical downturn of 5.1%, continuing a contraction that began in late 2025.
Right.
Finally, the seventh segment is specialty products, which is essentially a collection of highly profitable, patent-protected niche lines covering everything from beverage packaging machinery to appliance components.
You have cars, commercial ovens, welding torches, construction fasteners, and chemical polymers. That is an incredibly vast portfolio. When you mention this structure is highly decentralized, how does that actually function in practice? I mean, how do you prevent 88 divisions from collapsing into bureaucratic chaos?
Decentralization functions as a survival mechanism at this scale, honestly. ITW instills what they explicitly call an ownership mindset.
An ownership mindset.
Right. The corporate headquarters in Glenview, Illinois, is not micromanaging the daily factory floor metrics in, say, a German welding plant or a Japanese plastics facility.
They let them run themselves.
Exactly. By empowering the local management of those 88 divisions, those teams can respond rapidly to hyper-local market shifts. A local manager knows their specific customers' pain points and supply chain constraints far better than some executives sitting in a corporate boardroom analyzing a spreadsheet.
Yeah, that makes sense.
It structurally allows ITW to act like a fleet of small, agile businesses rather than a slow-moving conglomerate, despite the fact that they generate, over $16 billion in annual revenue.
That paints a very clear picture. We have a highly diversified, decentralized grid of 88 agile divisions scattered across the economic cycle. Let's shift our gaze to the other side of the arena. Contrast that sprawling, independent ITW architecture with the machinery of Ingersoll Rand.
Okay, so if ITW is a sprawling, diversified grid, Ingersoll Rand is a concentrated, deep vertical strike. They completely reject the seven-segment approach. Instead, they operate just two massive platforms, both fanatically dedicated to the physics of mission-critical flow creation and life sciences.
Flow creation is one of those terms that sounds elegant in an annual report but requires some unpacking. What are the actual mechanics of what they're building?
Flow creation is basically the science and technology required to move air, gas, liquids, and powders under extreme pressure and with absolute mathematical precision.
Like massive pumps.
Exactly. Their first segment is Industrial Technologies and Services, or IT&S. This serves as the historical beating heart of Ingersoll Rand. It encompasses heavy-duty air and gas compression systems, industrial vacuums, massive centrifugal blowers, fluid transfer equipment, and professional power tools.
So if a factory needs to move air,
If a major automotive factory needs to generate thousands of psi of compressed air to run its entire pneumatic assembly line, they are almost certainly relying on an Ingersoll Rand or a Gardner-Denver rotary screw compressor sitting in the utility room.
right, and the second platform.
The second segment is Precision and Science Technologies, or PNST. This is the domain of highly specialized fluidics. We are looking at precision chemical dosing pumps, like the Milton Roy brand automated liquid laboratory handling equipment, and crucially, a massive, aggressive pivot into the life sciences sector.
Life sciences, that's a big shift.
A huge shift. They are manufacturing single-use biopharmaceutical containment packaging and intricate medical device component assemblies. This strategic shift is heavily bolted onto their recent acquisition of a company called ILC Dover.
So here is where the philosophical divergence really crystallizes. ITW leans entirely into decentralization, trusting local managers to run independent playbooks. Ingersoll Rand uses a completely opposed operational model to manage its brands.
They absolutely do. Ingersoll Rand relies heavily on tight vertical integration and a proprietary system they call the IRX model, which stands for Ingersoll Rand Execution Excellence.
IRX, got it.
ITW lets divisions run localized playbooks, but Ingersoll Rand uses IRX as a standardized, aggressive framework designed to extract synergies across its highly complementary flow control brands. When Ingersoll Rand acquires a new company, they immediately plug that target directly into the IRX system.
Just force them into the mold.
Yeah, they standardize the reporting metrics, optimize the supply chain purchasing power, and relentlessly accelerate the operational cadence. It's a highly centralized execution engine engineered to continuously transform the businesses they ingest.
Okay, let me ground this in an analogy for you, the listener.
Mm-hmm.
ITW operates like a decentralized fleet of 88 highly specialized speedboats. Each speedboat has its own captain, its own navigation map, and its own immediate destination. They can independently navigate choppy local waters without ever needing to radio an admiral for permission to turn.
That's a great way to put it.
Right. But Ingersoll Rand, conversely, is a dual-engine juggernaut. It is a massive nuclear icebreaker. It is structurally designed to absorb smaller vessels, haul them on board, plug them directly into its massive centralized engine, the IRX system, and aggressively expand its radius of destruction straight through the ice.
That visualization perfectly captures the operational reality. Furthermore, what makes this comparison so critical for anyone analyzing these stocks is what these two distinct architectures structurally exclude.
Exclude, meaning what they don't do.
Exactly. What they deliberately choose not to do shapes their risk profiles entirely.
The exclusions are fascinating. Because of ITW's sprawling 7 segments, they inherently carry unique exposure to highly cyclical, consumer-facing sectors. The food equipment segment rises and falls with restaurant expansion capital and institutional budgets. Construction products is violently tethered to global residential building trends, lumber prices, and interest rates.
And Ingersoll Rand avoids all of that.
Right. Ingersoll Rand has zero exposure to commercial ovens or suburban housing starts.
Precisely. Ingersoll Rand is deeply embedded in heavy infrastructure utilities. Their revenue is tied to municipal wastewater aeration upgrades, oil and gas vapor recovery systems, and, increasingly, the highly regulated, structurally defensive world of biopharmaceutical containment.
Now, while a fleet of speedboats and a massive icebreaker operate with entirely different mechanics, they are ultimately sailing in the exact same ocean. This structural divergence we just mapped out dictates exactly where and how these two industrial giants physically collide on the factory floor.
Oh, they definitely collide.
Despite their wildly different philosophies on how to build a business, they are actively fighting for the exact same procurement dollars in some very specific, high-stakes niches.
And that collision brings us to the competitive overlap audit. Stripping away the corporate jargon reveals a fierce battleground. In several key channels, an industrial buyer at an engineering, procurement, and construction firm, an EPC, is sitting at a desk looking at a technical quote from ITW and a quote from Ingersoll Rand for the exact same multi-million-dollar project.
Let's get into the forensic details of that battleground. Where does the first major collision point occur?
The first major overlap is in the hyper-clean world of test and measurement and lab automation. ITW dedicates an entire segment to test and measurement and electronics. They engineer electronic assembly machinery, microelectronics consumables, and static contamination controllers.
Some clean room stuff.
Exactly. These are products designed for clean rooms where a single dust particle or a stray static charge can literally destroy a silicon wafer.
And Ingersoll Rand is playing that exact same high-tech sandbox.
They are heavily entrenched there through their Precision and Science Technologies segment. Ingersoll Rand has aggressively reinforced this position, notably acquiring a company called Sinomics in early 2026.
Sinomics.
Yeah, that acquisition allows Ingersoll Rand to deliver automated liquid handling robotics and highly precise syringe pumps utilized for diagnostic testing and in vitro laboratory sampling. If a pharmaceutical company is outfitting a new high-tech diagnostic lab or a microelectronics clean room, the procurement manager is actively evaluating ITW's contamination control software against Ingersoll Rand's automated liquid handling systems for a share of the lab's budget.
The lab automation overlap is very clear. Let's move to the heavy industrial side. Where else are their sales engineers bumping into each other?
The second massive collision occurs in the unforgiving world of industrial chemical fluids. ITW's polymers and fluids segment engineers specialize chemical fluids, industrial structural adhesives, heavy-duty sealants, and the abrasive lubricants used to clean or bond massive industrial machinery.
They formulate the actual physical compounds like the abrasive goop that keeps a factory running or permanently bonds structural steel.
They do. However, those specialized fluids and abrasive chemical polymers do not magically transport themselves across a processing plant.
Right.
They are highly viscous, frequently corrosive, or required to be applied in mathematically perfect micromilliliter doses. That exact constraint is where Ingersoll Rand enters the picture.
Ah, I see.
Ingersoll Rand's PNST segment manufactures the progressive cavity pumps and the highly specialized Milton-Roy dosing systems, explicitly engineered to transfer, meter, and pump the exact types of abrasive chemical fluids that ITW formulates.
Okay, I need to challenge this framing on behalf of the listener. Let's look at this logically. ITW creates the specialized industrial fluid. Ingersoll Rand manufactures the highly specialized pump needed to move that exact fluid. From an engineering standpoint, aren't these two companies occasionally complementary rather than strictly competitive?
It seems like it, right?
Yeah. I mean, if ITW makes the fluid and IR makes the pump that moves it, why are we viewing this as a collision? How do massive industrial buyers like an EPC firm actually view them in a bidding war?
Exploring that dynamic cuts to the absolute core of industrial procurement economics. On a purely technical level, yes, the fluid and the pump work in tandem. But from a capital allocation standpoint for the buyer, ITW and Ingersoll Rand are fiercely competing for the exact same finite capital expenditure budget.
A CapEx budget.
Exactly. When a massive EPC firm designs a new chemical processing plant, they have a strict predetermined budget for the entire fluid management infrastructure. Both ITW and Ingersoll Rand send their top sales engineers into that EPC firm. Both are pitching their specific products based on the exact same underlying value proposition, maximum uptime, and absolute reliability. They're fighting for the wallet share of the overall project.
So the buyer has, say, $100 million to build a plant, and both companies want the largest possible slice of that pie by convincing the buyer their specific component is the most critical.
That is the exact mechanism. And this introduces the concept of the high cost of downtime dynamic. In these specific overlaps, both companies provide products where failure is mathematically catastrophic.
Catastrophic how?
Consider the manufacturing of small molecule APIs for oncology drugs. You aren't just casually mixing powders in a vat. A dosing error of a fraction of a milliliter or microscopic contamination from a standard, cheap pump seal instantly ruins a $10 million batch of pharmaceuticals. Ingersoll Rand's PNST pumps aren't just moving liquid, they are providing mathematical certainty.
And the stakes are just astronomical. If an ITW static contamination controller fails in a microelectronics lab, an entire batch of next-generation semiconductors is reduced to garbage. The component itself might only cost a few $1,000s, but the financial penalty of it breaking is measured in millions.
Exactly. And because the cost of downtime is so punitive, industrial buyers do not hunt for the cheapest option. They hunt for the most reliable option, essentially buying a localized insurance policy.
Right.
The barrier to entry in these niches requires immense capital investment in research, extreme stress testing, and flawless quality control. ITW and Ingersoll Rand are both engaged in a high-stakes psychological battle to convince the buyer that their specific component is the ultimate fail-safe for the entire system.
We have the high-tech lab overlap and the chemical fluid management overlap. Is there a third major battlefield on the factory floor?
Yeah, engineered fastening and material handling. ITW dominates the engineered fastening systems market through its construction and automotive OEM segments. They engineer the automated fasteners, the heavy-duty structural clips, and the permanent components that literally hold commercial buildings and vehicles together.
Where does Ingersoll Rand insert themselves into that workflow?
Ingersoll Rand competes directly for the workflow efficiency of those very assembly lines via its Industrial Technologies and Services segment. They operate an extensive professional power tool and lifting division.
Like massive factory tools.
Right. They supply the high-torque, cordless fastening systems, the precision pneumatic bolting tools, the massive hoists, and the ergonomic lifts that the factory workers physically use to assemble the heavy automotive and aerospace components. They are overlapping on the exact same factory floor, targeting the exact same plant manager's limited budget for assembly line speed and worker safety.
Competing in these high-stakes, high cost of downtime niches requires immense operational discipline. You have to build flawless equipment because your customer's entire business model depends on your reliability. How each of these companies chooses to extract profit from these shared markets brings us to the absolute core of their financial identities. It's time to dive into the margin forensics.
This is where the structural philosophies we discuss translate directly into cold, hard cash on the balance sheet. Analyzing the drivers of profitability found in the industrial growth versus margin trade-off data is highly revealing. We must begin with ITW's margin fortress.
Margin fortress sounds hyperbolic until you look at the Q1 2026 earnings report. Walk us through those numbers.
In Q1 2026, Illinois Tool Works delivered a 25.4% operating margin.
Insane.
Furthermore, their executive management team guided that they expect to push that figure up to between 26.5% and 27.5% for the full year.
Wow.
In the world of heavy industrial manufacturing, where companies deal with raw steel, volatile chemicals, massive physical supply chains, and expensive global labor forces, operating at a 26% to 27% margin is an anomaly. It's best-in-class performance that looks more like a tech company than a manufacturer of welding torches.
If you are listening to this and thinking a 26% operating margin on commercial ovens, software companies barely pull that off, your skepticism is completely justified. How does a company making heavy physical machinery achieve that? They can't possibly just rely on pricing power to gouge the customer.
No, pricing power plays a role, but the true engine is an operational obsession called the 80/20 front-to-back process, specifically utilizing PLS product line simplification. This is the absolute heartbeat of ITW.
Fabulous.
Right. The classic 80/20 principle states that roughly 80% of your profits come from 20% of your customers or products. Almost every business school graduate knows this.
Right, Pareto's principle.
Exactly. But ITW weaponizes it. They relentlessly identify their most profitable, high-value opportunities, the 80, and they aggressively, without sentimentality, eliminate the cost, complexity, and structural distractions associated with the less profitable accounts, the 20.
Let's go back to my scenario from the introduction. We aren't just talking about a mild restructuring. They actively tell their own sales reps to fire paying customers. They intentionally shut down active manufacturing lines.
They absolutely do. They will willingly let commoditized contracts expire without bidding on a renewal. If a product line generates steady revenue, but the underlying margin profile sits below their strict internal thresholds, they simply cease production. Internally, they refer to this painful process as margin carving.
Margin carving. That is brutal.
It is. ITW's management views top-line revenue as a dangerous vanity metric if it does not carry an elite margin. They are constantly stripping away the commoditized, lower-margin layers of their revenue base to fiercely protect their core profitability.
The psychological discipline required to execute that is staggering. Picture a sales vice president sitting in a boardroom telling the CEO, "We are going to walk away from a legacy account with $4 million in annual sales because the margin is only 15%. In most publicly traded companies, that VP would be fired for destroying top-line growth.
Oh, without a doubt. It requires an iron stomach from both management and the board, but the results validate the pain. The 80/20 PLS system allows ITW to free up massive amounts of engineering talent, marketing budgets, and supply chain bandwidth, which they then redirect exclusively toward their highest profit customers.
So let me deepen an analogy for the listener here. ITW's margin carving is exactly like running a 3-Michelin-star restaurant. You have a highly restricted menu. You only offer 5 dishes. But the sourcing of the ingredients is flawless, the execution is mathematically perfect, and the service is impeccable. Because of that perfection, you charge a massive, unassailable premium.
Exactly.
If a customer walks in and demands a cheap burger, you politely show them the door.
You fire the customer.
Exactly. The ITW playbook relies on margin carving to maintain a 25.4% elite standard. Now, contrast that 25.4% operating margin against the financial engine of Ingersoll Rand.
The contrast is visually stark on a spreadsheet. In that exact same Q1 2026 period, Ingersoll Rand posted a 15.7% adjusted operating margin. Looking further up the income statement, their gross margin compressed down to 42.9%.
A 15.7% operating margin sits almost a full 1,000 basis points lower than ITW. Heavy manufacturing math dictates there are specific levers dragging that down. Why is Ingersoll Rand operating with significantly less headline profitability?
2 profound causes drive this margin compression for IR, and both link directly to their identity as an aggressive growth compounder. First, we must examine their tariff pass-through strategy.
Okay, tariffs.
Global supply chains have recently absorbed significant volatile tariff shocks. ITW's management explicitly stated on their earnings call that they are basically neutral on price versus cost and aren't even factoring specific tariff recovery into their 2026 guidance because their margins are already so thick.
They just absorb it.
Pretty much. Ingersoll Rand, however, utilizes a strict one-for-one pricing pass-through strategy.
Walk us through the heavy manufacturing math of a pass-through. How does passing a cost directly to the buyer actually hurt their reported margin?
It is a mathematical quirk of accounting, but a crucial one for an investor reading an earnings report to understand. Suppose Ingersoll Rand's cost to manufacture a massive centrifugal blower increases by exactly $100 due to a new steel tariff. They immediately raise the final price to the customer by exactly $100.
Okay, that makes sense.
Right. They protect their absolute gross profit in pure dollar terms. However, because the total top-line revenue number increased by $100, but the profit dollar amount stayed completely static, the overall gross margin percentage mathematically dilutes.
Ah, I see.
They actively trade away their margin percentage to protect gross profit dollars and maintain market share during inflationary tariff shocks.
That mathematical dilution explains a significant portion of the gross margin compressing to 42.9%. What is the second structural cause dragging down their profitability?
The second cause is an aggressive, intentional inventory accumulation strategy. Ingersoll Rand's balance sheet reveals they are actively holding $154 million in unliquidated operating inventory.
Wait, 154 million just sitting there?
It's just sitting there. In an era plagued by macroeconomic supply chain friction and sudden part shortages, they are choosing to tie up massive amounts of operating working capital in physical inventory. They want absolute assurance they never miss a customer order because a sub-tier supplier couldn't deliver a valve. They deliberately prioritize top-line fulfillment and market share capture over maintaining a hyper-lean balance sheet.
And beyond the tariffs and the inventory, there's a broader philosophical reason their margin sits at 15.7%, and it ties directly back to the IRX integration system we discussed earlier.
Yes. Ingersoll Rand willingly accepts what analysts call margin friction. Remember their core identity. They're an aggressive serial acquirer.
Right, the M&A machine.
When Ingersoll Rand buys a founder-led niche flow control company, that target company is almost never operating at peak corporate efficiency. When Ingersoll Rand ingests that company and consolidates the financials, the target's lower margins immediately drag down IR's blended corporate average.
They inherit the bad margins.
Exactly. But Ingersoll Rand accepts this short-term dilution without panic because they trust their IRX execution framework. They deploy their corporate integration teams to squeeze out the operational waste, optimize the supply chain, and expand the margins of the acquired company over a 12 to 36-month horizon. They embrace short-term margin friction as the necessary price for long-term scale and aggressive market capture.
So, using my earlier analogy, Ingersoll Rand is buying up independent buffet restaurants across the state.
Wow.
The food cost at those buffets is high, the kitchens are chaotic, and the initial profit margins are terrible.
Terrible.
But the IRX system acts as a team of elite corporate chefs who parachute into the newly acquired buffets. They standardize the ingredient ordering, replace the inefficient ovens, and systematically squeeze the waste out over 36 months. Eventually, that buffet prints cash, and more importantly, you now control the entire town's food supply.
That analogy captures the essence of the value versus growth dynamic playing out in the industrial sector perfectly.
This entire margin discussion leads us to a critical existential pivot. If ITW is constantly carving away its own revenue base, if they are actively kicking people out of the Michelin star restaurant to protect their 26% margin, how do they survive? Mathematically, if you keep firing the bottom 20% of your customers, eventually you shrink to zero. How do they avoid shrinking into oblivion compared to Ingersoll Rand's aggressive buffet strategy?
That is the exact vulnerability every Wall Street analyst probes when evaluating ITW, and it requires us to reconcile their disparate revenue engines. While ITW ruthlessly defends its margin fortress, Ingersoll Rand is moving at blinding speed on the top line. The Q1 2026 top-line velocity metrics expose this divide perfectly.
Lay out the growth metrics from that quarter.
Ingersoll Rand reported a massive 7.6% top-line revenue velocity, bringing in $1.85 billion for the quarter. To highlight exactly how heavily that top line is fueled by their inorganic M&A engine, $63.9 million of that Q1 revenue was generated exclusively from recently completed acquisitions.
And how did ITW's top line perform while carrying that elite margin?
ITW reported total revenue growth of 4.6%, hitting just over $4 billion. But a serious investor has to look under the hood of that headline number.
What's hiding in there?
A massive 3.9% of that total growth was purely a foreign currency translation tailwind, simply an accounting benefit from favorable global exchange rates. Their actual disciplined organic growth was a remarkably stagnant 0.4%.
A 0.4% organic growth rate. If you read the transcripts of the Q1 2026 earnings call, you can literally see the analysts getting frustrated with ITW management. Analysts were pressing the CEO, Christopher O'Herlihy, about this exact stagnation. If I'm looking at my portfolio and I see a global titan the size of ITW barely scraping 0.5% of organic growth, that sounds terrifying. Well, Hurley didn't apologize for it, did he?
He did not apologize because the stagnation is a feature, not a bug, of their philosophy. The CEO essentially defended it by pointing out that the PLS process product line simplification inherently restrains top-line growth. The CFO, Michael Larson, openly admitted that their PLS efforts, combined with a specific $100 million delay in Middle East sales, shaved roughly a full percentage point off their organic growth rate in Q1. They are intentionally applying the brakes to their own revenue to maintain the margin.
But they must have a formidable defensive moat to protect the highly profitable revenue they do choose to keep. Otherwise, competitors would easily pick off their remaining premium clients.
Their defense against shrinking to death is their proprietary CBI framework, customer-backed innovation. Because ITW is so intimately focused on their top-tier 80 customers, they innovate from the customer-specific pain point backward into the lab.
They build what the customer actually needs.
Exactly. They do not sit in an R&D facility guessing what the market might buy next. They co-invent highly specific engineered solutions directly with their biggest clients. This deeply integrated process has resulted in a staggering moat of over 21,800 granted and pending patents.
21,000.
Over 21,800. Once ITW engineers a custom, patented fastening solution directly into an automotive OEM's global assembly line, the switching costs for that automaker are astronomical. It becomes nearly impossible for a competitor to dislodge ITW without forcing the automaker to re-engineer their entire process. That 21,800 patent portfolio is their shield.
Okay, so ITW relies on a massive patent moat and customer-backed innovation to lock in the highly profitable revenue they retain. What serves as Ingersoll Rand's moat? If they are rapidly acquiring all these niche companies at 7.6% top-line velocity, they need a mechanism to keep those new customers sticky.
Ingersoll Rand relies on the industrial holy grail, the aftermarket annuity. 37% of Ingersoll Rand's total revenue and a massive 40.6% within their core industrial technologies and services segment comes entirely from recurring service contracts, replacement parts, and proprietary consumables.
Explain the physics and economics of that aftermarket. Why is it such a powerful financial shield?
Well, consider a massive rotary screw air compressor installed in a critical manufacturing plant. That highly engineered machine has an expected useful life of 10 to 12 years. From the moment it is bolted to the floor and turned on, it requires constant, specialized maintenance.
It's not just set it and forget it.
Not at all. It demands proprietary lubricants, specific replacement air filters, complex vibration diagnostics, and certified technician service hours to prevent a catastrophic factory shutdown.
And we are back to the high cost of downtime. When downtime costs a plant $50,000 a minute, the plant manager stops caring about the premium sticker price of a proprietary replacement filter.
Exactly. The factory manager will happily authorize a premium payment for certified Ingersoll Rand replacement parts because the risk of a generic third-party part failing is financially ruinous. Over that 10 to 12-year lifespan, the cumulative revenue captured from those high-margin aftermarket parts and services will typically far exceed the initial purchase price of the machine itself.
So the machine is just the hook.
The initial multi-million-dollar sale is merely the entry ticket. The aftermarket annuity is the hidden engine where the long-term wealth is generated. Crucially, it provides a massive, high-margin cash flow shield during macroeconomic down cycles. Even if a factory completely freezes its capital expenditure budget and stops buying new equipment during a recession, they must continue servicing the equipment they already operate just to keep the lights on.
IR utilizes the aftermarket annuity, and ITW utilizes the patent moat. But any analysis of Ingersoll Rand's growth velocity is incomplete without addressing their massive structural pivot into life sciences. What are the mechanics of that shift?
This represents perhaps the most aggressive, well-timed strategic transformation in the industrial sector this decade. Ingersoll Rand recognized massive secular tailwinds forming in the medical and biopharmaceutical spaces. In 2020, life sciences constituted just 4% of their business. As of mid-2026, driven by aggressive M&A, specifically the massive ingestion of ILC Dover and Flexin, they have scaled that exposure to 18%.
Scaling a division from 4% to 18% of a multi-billion-dollar portfolio in just 6 years is a staggering realignment. What specific tailwinds are they capturing in the life sciences space? We constantly hear about GLP-1 and ADCs.
They're capturing the physical infrastructure required for the most lucrative pharmaceutical breakthroughs of our time. We are talking about the booming end markets for GLP-1 weight loss therapies and antibody drug conjugates, or ADCs, heavily utilized in next-generation oncology.
To be clear, Ingersoll Rand is not formulating the chemical weight loss drug.
No, no. They are manufacturing the picks and shovels for the pharmaceutical gold rush. The mass production of small molecule APIs and the delicate handling of the highly potent volatile powders required for these advanced drugs necessitates extreme containment to protect both the purity of the product and the safety of the lab workers.
So the pumps again.
Exactly. Ingersoll Rand's life science platform engineers the high-margin, single-use containment packaging, the automated liquid handling robotics, and the precision dosing systems that the major pharmaceutical titans completely rely on to safely scale their production. This life sciences segment delivered double-digit organic order growth in Q1 2026. It acts as a high-velocity, high-margin engine strapped securely to the side of their traditional industrial compressor business.
The contrast is perfectly defined. ITW accepts 0.4% organic growth, leveraging its 21,800 patents to fiercely protect its 25.4% margin. Ingersoll Rand leverages its massive aftermarket annuity as a defensive floor while aggressively buying its way into the booming life sciences sector to drive 7.6% top-line velocity. That fundamental difference in how they generate revenue directly dictates the dramatically different ways they manage their balance sheets. How do these two giants actually deploy the billions of dollars they generate?
And this brings us to the ultimate proof of their philosophies: capital allocation. We are looking at the shareholder return fortress versus the velocity pipeline. If you hold these equities in your portfolio, this is where you actually feel the impact of everything we've analyzed. Let's begin with ITW.
Right. How did they deploy the cash generated by that elite margin?
ITW treats its cash flow with clinical, almost automated precision. They convert nearly 100% of their net income directly into available free cash flow. Because their internal operations are already ruthlessly optimized through the 80/20 PLS process, they do not need to hoard that cash to fund massive external acquisitions.
So what do they do with it?
They operate as a fortress of shareholder return. In 2025 alone, ITW distributed an astonishing $1.78 billion in dividends to its shareholders.
They distributed $1.78 billion, and Wall Street classifies them as dividend king, correct?
Yeah.
That signifies they have actively increased their dividend payout every single year for over half a century.
That is correct. A track record of over 50 consecutive years of dividend growth is exceptionally rare. But their capital return didn't stop at the dividend. In addition to that $1.78 billion, they also deployed $1.5 billion in stock buybacks in 2025.
Wow. Over $3 billion total.
Yeah, they are systematically returning over $3 billion a year directly to the people who own the stock. They are constantly reducing the overall share count, increasing your percentage of ownership, and paying you cold cash simply to hold the equity.
Contrast that shareholder fortress with Ingersoll Rand's velocity pipeline. If IR isn't handing all its cash back to the investor in the form of massive dividends, where exactly is that capital going?
Ingersoll Rand operates a relentless M&A compounding engine. They utilize their operating cash flow to constantly hunt for strategic bolt-on acquisitions. In 2025 alone, they successfully acquired, closed, and began integrating 16 different companies.
16. Ingesting 16 companies in a single calendar year is a blistering operational pace. That is more than one complex corporate integration every single month.
It is an aggressive cadence, and their ambition is growing. They have over 200 prospective targets actively managed in their M&A pipeline, with 10 deals sitting at the letter of intent stage as we speak. They specifically target founder-led, family-owned niche players deeply embedded in the flow control and life sciences space.
And are they overpaying?
No. Importantly, they are highly disciplined regarding valuation. They average a purchase multiple of roughly 9x pre-synergy EBITDA.
For the listener trying to contextualize that, buying a specialized industrial manufacturer at 9x EBITDA is considered highly disciplined. It leaves significant room for the IRX system to extract value. Give us an example of the specific assets they're hunting.
Well, recently they acquired a highly specialized Milan-based company called Fox SRL, which manufactures elite flow and pressure control equipment. That acquisition was plugged directly into their precision and science technologies segment to bolster their European footprint.
Makes sense.
In a separate move, they deployed $97.8 million in cash to acquire SSI Aeration, a premier manufacturer of wastewater treatment equipment. They immediately bolted SSI onto their industrial technology segment, perfectly pairing SSI's aeration technology with IR's massive low-pressure blowers to offer municipalities a complete end-to-end wastewater solution.
So they locate a niche Italian pressure control firm or a critical wastewater aeration company, buy them with cash, and immediately plug them into the IRX system to aggressively expand the acquired margins.
Exactly. And the IRX system isn't just about optimizing supply chains, it is deeply focused on human capital. Ingersoll Rand actively utilizes an ownership works culture. They utilize their cash flow to fund massive all-employee equity grants.
To the workers they just acquired.
Yes, when they buy a family-owned business, they ensure the employees of that newly acquired business feel like actual owners of the multi-billion-dollar parent company. This strategy meticulously aligns the entire global workforce with management's aggressive growth targets.
Let me summarize these diverging cash philosophies for you, the listener, because it paints a vivid, actionable picture. ITW treats its cash like a fully mature crop. The moment that cash is generated, it is immediately harvested, packaged, and handed directly back to you, the shareholder, in the form of billions in reliable dividends and buybacks.
Right.
Ingersoll Rand, on the other hand, treats its cash entirely like fertilizer. They relentlessly use that cash to acquire more land, buy more seeds, and aggressively plant new crops through serial M&A, betting that the exponentially larger size of their future farm will generate vastly more wealth for the investor.
That divergence, immediate quality and return versus aggressive velocity and reinvestment, is reflected directly in how institutional Wall Street views these two stocks.
How does the street price these profoundly different philosophies?
Currently, institutional analysts view Illinois Toolworks as a cautious hold. The street universally acknowledges the bulletproof defensive nature of the 80-20 model and highly values the absolute stability of the dividend. However, they are deeply wary of the self-imposed organic growth constraints and the high valuation premiums the stock commands.
Basically, the lack of top-line growth scares them.
Yeah, and technical indicators have flagged minor negative sentiment recently due to open market selling by key insiders. It is an exceptionally brilliant company, but Wall Street struggles to model massive stock appreciation if the total revenue isn't expanding.
How does the street model Ingersoll Rand?
Wall Street broadly views Ingersoll Rand as a strong buy with significant upside potential. Analysts are betting heavily on the proven efficacy of the IRX execution engine. They look at the 16 acquisitions completed in 2025, the highly strategic pivot into the high-margin life sciences sector, and the massive pipeline of future deals. The Street believes IR will successfully extract the promised synergies from these acquisitions and compound enterprise value at a rapid, market-beating pace over the next few years.
So we have meticulously mapped the operational architectures, the high-stakes competitive overlaps on the factory floor, the deep margin forensics, and the drastically different ways these giants deploy their capital. It is time to synthesize this data and deliver the final verdict on the true risk and reward for your portfolio.
To deliver that verdict responsibly, we must conduct a final risk and friction audit. Neither of these paths is immune to macroeconomic danger. Let's systematically highlight the primary risks identified in the source disclosures, beginning with Ingersoll Rand.
What poses the greatest threat to IR's aggressive compounding engine?
The primary existential risk for Ingersoll Rand is severe margin dilution and integration friction. Attempting to successfully integrate a massive active funnel of 10 LOI stage companies while still digesting 16 recently closed deals requires monumental operational bandwidth.
It's just a lot to chew.
Too much to chew, potentially. The IRX system is highly effective, but it is not magic. They are actively fighting margin dilution from their tariff pass-through strategies, which drag gross margins down to 42.9%. Furthermore, they are carrying the heavy drag of $154 million in unliquidated inventory to buffer against supply shocks.
Right, the inventory liability.
If global industrial demand suddenly contracts, that massive inventory instantly transforms from a buffer into a massive liability, and the sheer cost of integrating all those acquired companies could severely choke their free cash flow.
They're also exposed to immediate geopolitical realities. Did the earnings data reveal any specific execution friction recently?
Yes, the Q1 2026 earnings explicitly revealed macroeconomic friction stemming from specific project delays in the Middle East. That delay temporarily weighed heavily on their short-term operational execution and directly contributed to slight negative organic growth in their core segment for the quarter. They're moving at blinding speed, but they are highly exposed to global volatility.
That defines the risk profile for the high-velocity compounder. What is the primary vulnerability for the ITW fortress?
ITW's primary threat is the terrifying risk of structural stagnation. Their fanatical, uncompromising reliance on the 80/20 product line simplification creates a severe self-imposed ceiling on organic top-line velocity. We saw this mathematically proven in Q1 with just 0.4% organic growth.
Barely moving.
And this becomes deeply structurally problematic if their highly cyclical end markets begin to cool off. ITW carries heavy exposure to commercial construction and consumer-facing food equipment. If a global recession triggers, restaurant expansions halt, and residential building freezes, ITW's top-line revenue could contract sharply. No amount of 80/20 margin carving can protect a company if the total volume of revenue simply evaporates.
We face the risk of indigestion for Ingersoll Rand and the risk of absolute starvation for ITW. It is time for the synthesis. How should an investor choose?
The choice entirely depends on the specific job you need your portfolio to do. If you require a bulletproof, cycle-resistant moat that operates with an elite software-like 26% margin, and you want a company that distributes billions of dollars directly back to you in premium cash dividends and steady buybacks, Illinois Toolworks is the undeniable choice. It operates as the ultimate defensive cash-generating vault.
But if you demand high-velocity capital deployment, if you want aggressive inorganic market expansion, and if you want to actively capture the massive secular tailwinds of the life science and biopharma boom via a proven, ruthless M&A machine, Ingersoll Rand is the choice. They willingly trade short-term margin for velocity, relying on their massive aftermarket annuity to provide the defensive floor for their aggressive compounding.
That's the trade-off.
I want to leave you, the listener, with a final, forward-looking thought to mull over as you audit your own portfolio. We've explored the specialized speedboats and the nuclear icebreaker. We've contrasted the Michelin star restaurant against the aggressive buffet expansion. But look at the horizon. If global supply chain shocks and international tariffs escalate drastically over the next 5 years, what breaks first? Will ITW's 80/20 fortress finally be forced to sacrifice its sacred 26% margin? Or will IR's aggressive M&A engine suddenly choke on the integration costs of the 76-plus companies they've acquired since 2020? Keep an eye on those inventory numbers.
Risk defined, portfolio protected.